Health centers are breaking down, financial centers are breaking down and losing huge amounts of money, and the world economy leader don't know the answer. And this is the Big Short 2020. Now, obviously, I stole this title from this very important movie, very good one that I just recently had to see again during this turmoil on the financial markets. And obviously, this is so interesting to see if something like this that happened 2018 can happen in 2020 again. And the answer is it can happen. And today I want to discuss with you 3 topics and events that can lead to a huge financial downturn. And therefore, without further ado, let's roll.
Wolf of Dubai.
So of course, this kind of movies are easy to watch when you are having this situation and you are at home. Now, if you are stuck at home, or just be safe and play it safe and watch my vlogs. If not, make sure to subscribe and like this video. Now, I want to discuss 3 potential items that can lead to a financial crisis 2020. And therefore, the first one is definitely the index crisis. This is a theory by Michael Burry, the guy who foreseen the 2008 crisis and also is very active on the trading section. And he is a very good guy in numbers, as you may have seen in the movie, played by Christian Bale. So this is number 1 that we will talk about. Then we come to the small and medium-sized enterprises around the world, actually, not only in the US, but around the world, because this is such an important factor of the economy. This is the backbone of the European as well as the American economy, and therefore it's very important to see what's happening there. And the last part is a big event like the Lehman Brothers collapse scenario that finally gave the finish hit to let market to plunge so much, because nobody was expecting that it can become so bad. So without further ado, let's dive into the index crisis. So the index crisis theory by Michael Burry is actually something very interesting, because he believes that over the last couple of months the indexes got really swollen because hedge funds, people who wanted to invest and to be part of the 11-year bull market, just went into index funds, because index funds are really interesting, easily to manage, and are also recommended by financial advisors to be on the safe side. In the end, indexes, especially like S&P 500, making the best returns over a long period of time, and therefore it's easy going to say financial advisor to go for an index. And therefore people like you and me or our neighbors, everybody who wanted to invest, and big hedge funds that didn't could pick the right stocks just went into the index fund. And the index fund, for example, last year made 30% off return, one of the best years that we had during the bull market. However, what happens if something economically political, or like we have the health crisis right now, will influence the market to sell off? Now, this is actually happening. It's not that bad yet, as Dr. Burry is actually forecasting and thinking it could happen, but he is putting this scenario on the table that actually, if lots and lots of people withdraw their money from the markets, from these indexes, actually the indexes could break or be out of liquidity, because in the end of the day, also smaller companies are in these indexes. Even the neighbor next to you maybe have the index fund and don't know which stocks he's actually owning, and those are the ones that are at risk, because those companies, the smaller one, don't have so much trading volume to hold up if millions and millions of people, billions of dollars are getting removed from the indexes, and this can lead to a crash. And therefore he is in the opinion that something like this is very risky. This is something like the CDOs or the housing bubble that he saw, and he believes this is something similar, just in the form of index investing. So watch this out, how this will evolve. You have heard it here the first. So the second part is actually something that I came across while researching the current crisis. And I saw something very interesting. I said, obviously these big companies are affected, like airlines, the big manufacturing companies or software companies, all these companies are affected. But what happened to our smaller companies, like the travel industry, right? The restaurant business, bars, clubs, retail stores, all of those, they are medium and small size enterprises, less than 250 people as employees. And those are, and now hold your seat, because they are representing 99% of all businesses in the US. So you can imagine if those companies start to fail, a big part of almost all the major part of companies will fail in the US, which will bring chain reaction. And not only that, because this stop, I call it stop because it's almost a stop of our economy. It's not something that we saw on terror attacks or other financial crises, because then we just have like a demand problem. People stay at home, people want to enjoy, but they still go out for a restaurant, they still purchase normal things, they still buy this jeans or the t-shirt. But currently we have such a situation that people will start to panic or can panic and don't go out anymore, just hoard a massive amount of food and water and all these things that you need in their houses. And then what will happen is not only the demand will slow down, but also the supply, because also people will stay home. They cannot go to work because of close downs, lockdowns that we seem to not see at this moment in the US, but I think this could be a big problem. And therefore, this is the second beer scenario. Oh, wait a second, because I said a lot of beer. I know you guys don't like how I say bear. The bear market. So this is the bear scenario number 2, and therefore I believe that this kind of things can happen with this businesses. Moreover, 65% of all employment are these small and medium-sized companies, and about 45% of our economy in form of GDP is influenced by our small and medium-sized companies. So don't think only the big airlines, the big cruise ships, the big companies now that will lose a lot of money, that can just lay off a lot of people. But think about the businesses that completely will go out of business, the small one around you that are actually very, very depending on you, on your sales, and on your coming by to the coffee shop or whatever it is, the small supermarket and so on. So make sure to watch this as well, how the bankruptcy rate on this small medium businesses is actually doing, because some of those can develop into a bloodbath. This is something that it's called when companies are getting from quarter to quarter, from period to period, and we have seen the bankruptcy rate of companies didn't went straight like it should be, because always companies are failing, but it actually went down over the years because there was cheap money on the market, and there was also still always something that they could push to the next quarter, and therefore there's a lot of bad things in these companies. And now it's the time that the CEO says, hey, what, we cannot go on like this. This impact on our demand and supply is killing us, and therefore new CEO will come on board maybe, and then bring all these bad things out to daylight, and then you will see that there was a big problems underlining over the all companies, and also small companies trying to survive over months, and now really have big cuts in their revenue. And therefore this is a very, very important piece of the puzzle that you should watch, how the bankruptcy rate of small and medium companies will evolve and what the government is actually doing. Last but not least, if you're looking into financial crisis 2008, there was actually one special event that broke the whole market, which was the Lehman Brothers collapse. This was something that nobody have thought could happen. One of the biggest and oldest investment banks is actually falling down. Not only that, but also Merrill Lynch also fall down, and you have seen that this is really something that is really disturbing to our economy. Now, something like this is usually in the down part that we currently see. We still see a slow part, over the last couple of weeks. We're talking about weeks. We lost about 20% when entering slowly the bear market, and over the last couple of days we have seen that this slowly accelerates. So we have bigger movements up and we have bigger movements down. And now I think if there's one event, only one event, that will be of such a significant major impact on economy or political wise, then I think then a huge downturn for our stocks can happen. And something like this I would put in the line, like for example, if we finally can test people on the large scale perspective in the US, and we see there's maybe hundreds of thousands of people that have this, or maybe on the other side there will be some political tensions between countries in addition about the going further with this opportunity and challenges on the market right now, or other things that we cannot foresee right now. Maybe big collapses of companies could also trigger a big question to the overall economy. So therefore, watch out. These three things you should definitely have on your watch list, and let me know in the comments what you else need to know.